Hello, welcome to TaxAid's 2026 volunteer training. This training will cover what's new uh, for tax law changes that are most relevant to our clients. By way of introduction, my name is Andy Chang. I am a CPA and I currently work at Tesla's corporate tax department. I've been a volunteer at TaxAid for over 20 years now, and I currently run the Fair Oaks site in Redwood City. Before we get started, I just wanted to express my gratitude for each and every one of you, first for opening this training and to sit through this presentation on tax law changes, and also to express my gratitude for each and every one of you for volunteering for TaxAid, a program very near and dear to my heart. It's a great organization, but we couldn't do it without all of the time and energy that each of you bring and volunteer in this organization. So thank you again for joining us this year. Okay, couple of housekeeping items before we get into the nitty-gritty. This presentation will cover a lot of tax law changes. However, this summary is just presents basic information and is an oversimplification of tax law changes. Nothing in this summary should supplant or replace the full requirements of the tax code. The summary is not intended to be substitute for advice from a taxpayer's own legal and financial advisors. I like to think of this as a good starting point and covers high level what you'll need to know out on the field when you're preparing tax returns for clients. Additional information about tax law may be found on IRS's website. Okay. The agenda for today, we will go over, of course, what's new for tax year 2025, and then also cover tax law changes. We'll cover TCJA, we'll cover OB3, we'll explain what those acronyms are and how they're relevant for our clients. Okay. What's new? So the individual filing deadline for tax year 2025 returns, or 1040s, is April 15th, 2026. So the traditional tax filing deadline. That date falls on a Wednesday, so there will be no extension for holidays or weekends. Important note, if you have clients that have not filed their tax year 2022 returns, this filing season is the last year to, or the last season to file those returns. So if your client hasn't filed their 2022 tax returns, the statute is closing, so make sure that they file that this year. Okay. The income threshold for TaxAid's clients is, and this is a gross income limitation, is now $69,000. That, of course, is determined based on the EITC AGI limit. So any taxpayers above 69,000 for sure won't be eligible for the earned income tax credit, regardless of their income base, regardless of number of qualifying children. Always make sure that your screeners and the sites are enforcing those limits by checking their tax documents at the door. Okay. And then mileage rates for tax year 2025, 70 cents per mile for business miles for those clients that are filing Schedule C's, 21 cents for Schedule A medical medical miles, and 14 cents per mile for charitable miles, also deductible on Schedule A. Okay, let's introduce tax law changes by talking about two large packages. The first one is the 2017 tax law changes. We have to talk about the Tax Cut and Jobs Act of 2017 in order to provide the appropriate context for the one big beautiful bill. So in 2017, we saw this giant bill, which changed a lot of tax provisions that affected individuals. But the key thing here is that many of the provisions of TCJA, the Tax Cut and Jobs Act, were set to expire because many of these provisions were written not to be permanent changes to tax law, but temporary changes to tax law. Many of those provisions were going to expire at the end of 2025, which meant that without a tax bill to either extend or make permanent these adjustments, we would effectively roll back to tax law for individuals and businesses prior to 2017. So for those of you that are practitioners for at least the last 10 years, you would know that we would back in the old days, so to speak, we would have like the personal exemptions pop back up, or the SALT cap would be unlimited going forward. So in 2025, the one beautiful bill, or otherwise known as the OB3, actually extends or makes permanent a lot of the tax provisions in the TCJA. So now we can default and consider these changes to be permanent. It also introduces a lot of new tax rules, mechanics, provisions. We'll talk about some of those changes later on in this slide. Most of these changes do affect 2026 tax year 2026 again, because a lot of provisions in TCJA were set to expire at the end of 2025, but some of these changes were made retroactive to 2025, and we'll go over what those retroactive changes are. Okay, TCJA, let's go over some of the provisions that were set to expire. Individual tax rates were set to roll back to pre-TCJA levels, which meant that the highest earners would be subject to the old 39.6% maximum federal tax rates. The 37% tax rate, marginal rate, is now the highest marginal tax rate for federal income. That's made permanent now. Back 10 years ago, there used to be, in addition to the standard deduction or either itemized deductions in the form of personal exemptions, this was based on how large your household size was. The standard deduction was increased to account for the loss of the personal exemption, and that was set to expire. So again, we would have rolled back to the old days where there was the smaller standard deduction plus personal exemptions. Both of those were made permanent. So personal exemptions are no longer an item on the tax code, and the larger deduction, standard deduction, is now here to stay. The expanded tax credit was also set to expire. That was the $2,000 child tax credit. We'll talk about that later. It's now $2,200 and made permanent. SALT deduction, this is the Schedule A deduction for state and local taxes. This made big news in California because California has a higher tax rate and a lot of high income earners. That deduction is now made permanent. It would have expired, but it is now made permanent, and we'll go over that later on. TCJ also eliminated the so-called 2% of AGI miscellaneous itemized deductions. That would have expired, which meant that would have been brought back into the Schedule A. However, OB3 goes ahead and eliminates it permanently. And then TCJA introduced this concept of the qualified business income deduction. This is a 20% deduction available for taxpayers that invest in certain pass-through entities. That 20% deduction would have been rolled back if it wasn't for OB3. OB3 now makes that deduction permanent. Okay. OB3 changes. The first note here is that tax bracket thresholds now adjust for inflation. They don't stay static. Now, and that's a welcome change because now tax brackets will adjust for effectively cost of living. Again, OB3 permanently eliminates the concept of the personal and dependent exemption. It again is rolled into the larger standard deduction, so it's kind of a it just simplifies how the tax return mechanics work, and so that should be a welcome change. Standard deduction now adjusts for inflation just to keep up with CPI, et cetera. And then the earned income tax credit also adjusts for inflation. So these should all be viewed as very positive changes in OB3. Let's now move on to the enhanced deduction for seniors. This is an enhanced deduction on top of the standard deduction for 2025. These are for taxpayers that are 65 or older at the end of tax year 2025. This deduction, enhanced deduction, is worth $6,000. So that's on top of the standard deduction of $15,700 for single filers or married filing jointly. The threshold is, or the standard deduction is $31,500 for tax year 2025. Each eligible person would get this $6,000 additional deduction. So for married filing joint, and if both are over 65, then this deduction would be worth $12,000. The phase out begins with MAGI of 7,500. Sorry, 75,000. Not a problem for our clients since our threshold is 69,000 for gross income. This deduction, another nice feature of it is that it is above the line. Above the line just means that it will be 6,000 additional deductions for your taxpayers, whether or not they take the standard deduction or itemize their deductions. The Social Security number is required to take this, and we already talked about the age requirements. And this deduction is eligible, or this deduction is available for tax year 2025, 26, 27, 28, so 4 years. And then it sunsets after that. And we'll see this 4-year provision actually relevant for a lot of other OB3 features or new changes that we'll discuss. Okay. reduce taxes on tips. So this change to tax law made a lot of headlines this year as well. So the way this works is for your typical tip earner. So we're talking about Uber drivers, waiters, etc. Anyone who works in an industry in which where tips are customary. There is now a deduction available for the first $25,000 of tip income. The reason why this was structured as a deduction, but not an outright exemption or exclusion from taxable income, is because in order to keep the tip income eligible for EITC. So this is actually a good thing where you have a tip earner who can still optimize their eligibility for the EITC or earned income tax credit, but also that get the effect of a tax exclusion on tip income. This must be reported on the W-2. So the W-2 from the employer must identify tip eligible income. That amount we would punch into software, and the software should compute the amount of deduction. The deduction is available for both itemized and non-itemized filers. Again, this is not to disadvantage itemizers. Social Security is required for at least one of the taxpayers. And this deduction is available for the next 4 tax years, so it will sunset in 2028. Okay, similarly, OB3 introduced reduced taxes on overtime income. This deduction is worth $12,500 or $25,000 for married filing joint. The key thing here is that for your taxpayer, for your clients that earn overtime pay, it is actually not the entire pay designated as overtime. It is actually the excess pay above the base pay. So if in California, for example, if you work overtime, the employer has to give you time and a half based on your base tax rate. The 1X is not eligible for this deduction, but the half rate above the one before the one multiplier is eligible. So again, this needs to be separately disclosed on the employee's W-2. We would just need to punch it into tax software and should compute. You can't double dip if the tip is if it is also if that excess overtime pay over base pay is considered tips. But if your taxpayer has both tip income and separately has overtime income, qualifying overtime income, both of those would be eligible for the deduction. Social Security is required as well, and this deduction is available for the next 4 tax years, available for both itemizers and non-itemizers, again, not to disadvantage itemizers. Okay. The other new tax deduction that received a lot of attention under OB3 was the reduced tax on car loans. So for your taxpayers that purchase brand new vehicles, and the definition of vehicles is either a car, van, SUV, truck, motorcycles are eligible as well, but they must have gross weight of less than 14,000 pounds. So these would be essentially your passenger vehicles, commercial vehicles, trucks, etc. Those semi trucks wouldn't be eligible. Your taxpayer those cars, of course, have to be one of the other requirements is that it has to be assembled in the US. And you also have to provide the VIN on the vehicle identification number or the VIN needs to be disclosed on your taxpayer's tax return. So they need to bring their documents in order for you to take this deduction. And that $10,000 is if your taxpayer takes out a loan to purchase the new vehicle. The interest on that deduction is eligible for deduction. This deduction is available for itemizers and non-itemizers. Unfortunately, this deduction is not available for used vehicle purchases, and it is also not eligible for new leases. So only new vehicles purchased. And it can be cash or sorry, it can't be cash because you wouldn't have any interest on the cash. But it's for new vehicles purchased with financing, essentially. Unicycles are not excluded, so there's a two-wheel requirement for this deduction. Okay. Let's talk about credits under OB3. We touched on this earlier, but the child tax credit is now made permanent. And it also is expanded from the old tax credit limit of the child tax credit. Used to be worth $2,000 last year, or tax year 2024. It is now expanded to $2,200, of which the first $1,700 is considered refundable. So even if your client, your taxpayer does not have any taxes owed for the year, they would still be eligible for this. They still would be able to monetize the first $1,700 of this credit, and if they had any taxes paid in, they would get the full $2,200 of tax credits. This was made permanent, and in the future, this credit also adjusts for inflation. So this is good news for tax credit. So it doesn't stay static. It will also adjust for cost of living, essentially. In order to receive this credit, the qualifying child must have a Social Security number, and at least one of the parents needs to have a Social Security number. And then for your other dependents that don't qualify for the child tax credit, this would be older children, parents that meet the dependency test. They would be eligible for the $500 non-refundable credit. So your taxpayer would need to have some tax liability either paid in or would be due on the tax return. And that was made permanent as well under OB3. OB3 also introduces the Trump Savings Account. This account is for children under the age of 18. And this account operates like kind of a hybrid IRA/Roth IRA. This is a tax-deferred account. Parents can make contributions into it. Parents' employers may be able to make contributions into this account. It is not the contributions, though, into this account, this Trump account, is not tax deferred, however, so parents are only able to put in $5,000 a year of post-tax money. But the account is allowed to grow tax-free until the child is able to withdraw. They're not able to withdraw until they've reached the age of 18. Another key feature here is if the child was born in tax year 2025 or future children that were born between now and tax year 2028, government will provide the first $1,000 in order to start these accounts. Another key feature is employers that provide this benefit. Any contributions that they make on behalf of the employee to these Trump savings accounts for their minors, that contribution is not taxable to employees. Okay. And then when withdrawals are made from these Trump accounts, there is a pathway for the gains to be taxed as long-term capital gains if used for these qualifying purposes. Okay. We won't expect these to affect the tax returns that much, but you may get questions from your clients about the savings account. So it's good to have some high-level comments about them. Okay. So our final topic for this presentation today is the SALT cap. And this, again, made a lot of headlines, especially here in California, where where we have higher state rates compared to other states, and also lots of high income earners. So the SALT cap was introduced by TCJA. It capped off the amount of state and local taxes that a taxpayer may deduct on their Schedule A if they itemize. It used to be no cap, but now, or under TCJA, that cap was set to $10,000. OB3 extends the cap permanently. However, it also increases the cap from $10,000 to $40,000 for the next 4 years. This should be welcome news for your taxpayers that do itemize in California. There is a phase out if your income limit is over, I believe it starts over 150,000. So again, not relevant for our taxpayers, but just be mindful for any taxpayers that own their own home, if they have a lot of property taxes paid, or if they're on the higher end of our filing threshold, they may have enough state income in order to itemize. So that is it for content on the slide deck. If you have any questions, please email admin@taxaid.org or visit our website, tax/aid.org. Again, thank you for your time and attention to this presentation. Thank you again for being a volunteer for TaxAid 2026, and I hope to see you out there on the field. Please take care and have a great session. Have a great season, everybody.